We are in our worst slump of the year for stocks, and it got worse today. The Dow falling 237 points on a late-day slide. Bond yields, they moved down again. Buyers moving in. The averages ended on their lows of the day, and with heavy volume, never a good sign. But investors have been running for safety. Real estate at a record high, up 17% this year. Consumer staples and utilities both up 11% in 2019, also both near their highs. Here's the question. What do these runs, Guy Adami?
Yes, sir.
A buy in utilities, a buy in real estate, a buy in bonds, an inverted 3-month and 10-year bond. What does that tell you about the state of investors, the psychology of the market?
It means there's further, in my opinion, again, it means it's great to have you back again. We're going to have you tomorrow. It means there's further pain ahead in the S&P. And I think I've been pretty consistent on this. I think we're going to 2,650 or so in the S&P, about 150 or so S&P handles from here. I think that's relatively benign, and I think that would be very, very healthy for the broader market. It says to me that investors are looking for safety. I think they're going to the wrong places. But I'll say this, if you are looking for stocks that have already had a 10% move to the downside, I give you no further than the one we power pitched last week, and I got voted for yes across the board.
It was yes across the board.
It was Alphabet, and if you look, Alphabet actually had a decent day until late when everything got dragged
down. We led the show with Bon Jovi. I'll give you another one, Runaway, because you just said that investors were running to the wrong areas.
Right.
Why are they the wrong areas, and what are the right areas?
Well, I mean, if you look at, utilities, I think, have gotten way ahead of themselves. I understand why they would go there based on where 10-year yields are, but I think it's the wrong place at the wrong time. And if you go into Procter & Gamble, if you think there's safety in a name like P&G, I just point you to a 23 times forward PE and say, why would that stock in any environment trade at that multiple, least of which the environment we find ourselves in now?
So if 226 on the 10-year tells you exactly what markets are not excited for and for growth. And if you actually look at bond yields, we've broken through significant support, and it really doesn't look good here. So defense right now is certainly in yield plays, and those that give you some kind of relative increase over the 10-year. I would go to an AT&T and names that also have big balance sheets that people were very worried about in a rising debt environment. I think it's actually a place where their business looks a lot better. But be clear, consumer confidence was out today. It was kind of a head fake. We were at 3-month highs. But if you look at those ISM numbers last week, that's really what put the bond market into a buying frenzy. And again, yields are going lower. People are continuing to dump money into U.S. to play defense, along with the dollar, which continues to rally. And none of this is good for risk. To be clear, we're talking about playing defense. People are playing defense, in a sense, with stock markets only 3% from all-time highs, and yet this is not what the bond market is.
Karen, there seems to be one very simple and very important question in bond yields. Are bond yields moving down because people are afraid of a global slowdown, and so they're just kind of fleeing into treasuries? Or are they moving down because there's so much capital around the world that there's no place else to put it? And I say that because we're seeing bond yields move down in countries like Germany and Japan as well.
Right. Well, it could be both, right? I think part of it is definitely because people are afraid of a slowdown. I mean, I know I'm afraid of it now as the trade war, I don't know what else to call it now, but a trade war drags on. It's not just that a fix can fix things right away and no damage has been done. I think there is starting to be real damage done as companies try to position themselves. I mean, it's not so easy to move your supply chain. That's very difficult to do, but it's hard to know about how much should you be spending, what should you be looking for the top line, and not be conservative, right? And that sort of starts a vicious cycle of conservatism, lower spending, and that's kind of bad for everyone, and that plays into bond yields being lower because people are afraid of growth slowing. I'm afraid of it.
Yeah, so your question is whether it's a reflection on growth. I mean, all you have to do is go look at Germany, and you have to look at Japan, and we know that growth has been really weak. We know that their growth has been downgraded on numerous occasions, and we know where their U.S. or their treasuries or their equivalent of treasuries are trading. A lot of them are negative. So when you think back to the fall, when it looked like the U.S. economy was ready to take off, we had the 10-year treasury yield at what? 3 1/4, something like that, looking like it was going to break out or something like that. So here we are now, basically at 2 1/4, and all the things that Karen just mentioned are starting to weigh on global growth, but specifically our country.
Dan, the reason I asked that question is we've got to remember one very simple fact. Bond yields also moved down at the beginning of the year when stocks we're doing well. The bond move down has been a continuation of a trend. It hasn't just been a 3-week phenomenon like we have seen with the stock week.
Well, I think with stocks, though, in the beginning of the year, we just had this V reversal. I mean, we got so oversold in such a short period of time in Q4. And I think underlying that initial strength in January, we started seeing the data in the U.S. kind of weakening, too.
Plus, you had the Fed gone, right? December, they were on overdrive.
The Dovish pivot, I think, had a lot to do with that.
And by the way, speaking of the Fed guy, Adami, if we have this chart, I'm going to just kind of throw an audible out here. Omaha, which is the 3-month yield against the yield on the 10-year.
Negative.
Because, correct, positive. Jerome Powell said that's what you want to watch is not the 30-10, but the 3-month 10-year, Guy Adami. What is that telling us?
It tells you that global economies are slowing down in a meaningful way. When 24% of global sovereign bonds have negative yields, that's problematic. Now, stock markets until today have not cared. I think they better wake up and start to care because it augurs something really bad. So that number doesn't seem to be getting better. It seems to be getting worse by the day. So again, inverted yield curves historically have not been particularly bullish.
As preposterous as it may sound to people, especially as we talk about this, we have an 80% probability of a 25 basis point hike by year end. We also talked about bond yields, and not everything is going lower in Europe. In fact,
cut by year end, an 80% cut by year end.
By year end, but what we look in Italy, you see BTP yields actually are wider by 12 bips against bonds today. Whereas BTP land, that's Italy. That's a place where actually slower growth actually gets you to a place where people start to really be concerned about credit risks around the world. European banks hate negative yields and are getting destroyed. And if you look at big, as we've talked about this triple B threat in terms of credit land, all of these massive companies that are just a notch above junk, if we are really phasing kind of this low growth or downshifting as much as we're all talking about, this isn't this isn't about playing defense into better equities. This is about a very difficult time ahead.
And it's truly amazing, and not to jump the gun, but tomorrow on another 5 a.m. show,
Worldwide Exchange,
we're going to actually talk about the Italian banks, which have been quietly just obliterated in the last month or so. So we look at a negative yield on the 10-year note in Germany, Karen. The idea is I lend you money, you give me some money back to compensate me for my risk. People in Germany are now paying to borrow money. How insane is that? This is not Italy. This is the 4th biggest economy in the world with a negative yield on its biggest debt.
I don't know how to. There's a lot of weird things going on. Guy and I were talking about this in the green room. If I had told you 10 years ago in 2008 we would have a 10-year run of expansion, right? The market would be here, and the 10-year bond would be at 2. I don't know where it ended up closing today. You would say that's not possible. Those 3 things together, a 10-year run, stock market, all-time high.
Throw in 2% inflation and then where are real rates? I mean,
that's really what I'm saying. Thank you, Karen. You cleaned it up because this market environment is really, I hate to be sort of TB hyperbole, unlike any that we have seen in decades. But I've been doing this 20 years. I can't remember when all of those things you just mentioned were happening at the same time.
All of these things are a function, though, of a Federal Reserve that doesn't care about throwing as much money at the problem as they can. And that's why you have this cross current of actually bond yields that are going lower. By the way, a credit scare is the worst thing you can have. And obviously, if we want to look in the history books, we can look straight to Japan and see where we are dealing right now with a central bank that threw way too much money at the problem. So I'm not saying we're Japan. I can tell you right now, deflation is as important of an issue right now, folks, as inflation.
And quickly, we got to bring up Deutsche Bank. We're not bringing up today. This is something we've talked about on this desk now. Literally for years, the stock closed just above $7. And again, everybody, when I say everybody, the market seems to think that Deutsche Bank is Deutsche Bank specific. I am not certain of that. As a matter of fact, I'll say it again. If Deutsche Bank was a U.S. bank, I think we'd talk about it every day. And to think that Deutsche Bank is by itself just its own problem, I think is foolish. They have the largest derivatives book in the history of mankind. There has to be some systemic risk there.
And what is that? What is the systemic risk?
Well, you look at Citibank, for example, now trading $64 and trading just right around-ish tangible book. You wonder, with Citibank probably having the most exposure to Europe, is the weakness in Citibank over the last couple of weeks and until recently, the last couple of years, trying to tell you something?